Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 9, Long-Term Financing and Capital Structure. We've just completed a series of looking at capital budgeting. That's the process of selecting value-creating, positive NPV projects. Now you need to raise capital to fund that CapEx, and you're considering a number of alternatives: cash, equity, debt. This topic will evaluate different alternatives for financing the firm to maximize the value of the investment or even maximize the value of the firm. What this involves is minimizing the cost of capital. So let's talk about a first alternative. One alternative that firms tend to use is through retained earnings, and the cash associated with retained earnings, called internal funds, is you could finance your capital expenditures or other expenditures with cash. However, there are reasons why firms may hold cash or hoard cash. First, there might be transactional cash balances. So you may need cash just for to fill your registers, to handle customer requests for cash change. So what might happen is a company that has cash involved in the business would forecast cash outflows and cash inflows on a monthly basis and determine a minimum amount of cash they want to have on hand. A second reason firms may have to hold cash is compensating balances. Compensating balances are funds in which a borrower is required to deposit at a bank or other financial institution to satisfy the terms of a loan agreement. And usually this involves getting a better interest rate if you promise to deposit, say, 10% of the proceeds of the loan and keep them on deposit. So those are two reasons, the first two bullets, of why a firm would need to have cash. And in those two situations, I consider those almost like working capital. So all the examples we've done in the course so far, I've always said, well, let's just look at non-cash working capital as a measure of working capital. What I've basically done is I assumed that the firm does not have compensating balances or cash needs. The next two are more like optional cash positions. The first is precautionary balances. And that is just a firm that holds cash, just like you would hold cash in an emergency fund, for future downturns in the business or a recession or a future capital expenditure that pops up, a great opportunity. So firms just hold on to cash for the same reason that you'd hold on to cash in your checking account in case something comes up. And the third reason, and a major reason a lot of corporations hold a lot of cash, is they're trying to avoid repatriation taxes. Firms that earn profits in cash overseas are taxed on those profits in cash when they're transferred back to the States. To avoid this repatriation tax, which could be as high as 35%, you can just leave the cash overseas. And you can see the schedule in the bottom right that Apple in 2015 had $158 billion of cash on hand. 89% of that was held overseas. And what they're doing is they're trying to avoid the cash or avoid the tax. And what they're trying to do is, well, maybe someday they may need that money for a foreign venture purchase, acquisition of a company, or foreign capex. Or maybe someday they'll just offer a tax holiday on repatriation tax. So many firms are holding cash to avoid the repatriation tax. Another option is to use equity to finance a project, also called common stock. Now, the advantages of using equity as a financing tool or source versus debt is it has lower financial risk than using debt, right? Remember, a stock has no obligatory payment, right? Dividends are optional. The corporation may choose to pay them. However, if you issue a bond, those interest payments are contractual obligations. And if you default on them, you can go bankrupt. So remember, you can't go bankrupt if you have no debt. So a firm that has no debt has no chance of going bankrupt. The second advantage is the greater flexibility, greater equity cash flows. If you issue equity to finance your purchases, you don't have those fixed interest payments, which means you have higher cash flows. And those, again, are cash flows to equity, not cash flows to the firm. The disadvantages of using equity over debt is ownership is diluted when you issue more shares. So everyone's share of the corporation's profits fall when new shares are issued. Second, it's a signal that managers feel the stock is overvalued. So if a firm is thinking that their stock is really undervalued, they probably wouldn't want to issue the stock at that low price. So they might wait for the stock to be maybe a higher valuation, either fairly priced or overvalued. So sometimes market participants and investors feel it's a signal when firm issues equity to finance a purchase that they feel their stock is overpriced. Third, the cost of equity is generally higher than the cost of debt because debt is safer, right? A bond has contractual payments. You must pay them, otherwise you go into bankruptcy. Therefore, interest rates on bonds and debt are usually lower than what equity holders expect. Therefore, all else equal, issuing equity was going to raise your WACC. And lastly, dividend payments are not tax deductible. Interest payments are. So you don't get that tax shield that you would from debt. Now, on the stocks, how stock is issued and the types of stock, we have private equity and we have public equity. Public equity are the ones that are issued on exchanges and available through anyone's E-Trade or Schwab account. Private equity is not available to the general public. So in private equity, you might have venture capital or VC. That's very, very early stage funding for a company. And these VC companies, what they're looking for are companies that could really be big. Now, most of them won't turn out. They'll be a bust. But the idea is they're looking for these companies that have the potential to be really big. Now, private equity firms are firms that either purchase a firm that's currently private or actually purchase a public company. For example, Dell went from a private company owned by Michael Dell and some investors. It then went to a public company where the shares were traded on an exchange. And then later, the company went private again with Michael Dell and some other investors, took it private. So they had a situation where they bought out all the existing shareholders. And now you cannot buy Dell stock. And what these private investors are trying, or these private equity firms are trying to do, is they'll hold those firms for say 5 to 10 years and then resell them and usually go public again and try to make a profit on its resale. And we talk about LBOs, leveraged buyouts. These are just private equity investments that involve a lot of debt relative to the amount of equity that's being purchased. Now, public equity issuance are stocks in which you have a stock symbol, and you can look on your Schwab or E-Trade account or look in Yahoo Finance and get the information on it. So these are public companies or public equities. Now, the first time a company goes public, goes from private to public, it's called an initial public offering, an IPO. The public issuances have to be approved by the board of directors and have to be registered with the SEC. And companies like Goldman Sachs and other investment banks are involved in that process of helping companies value the securities, price the stock, and help market the stock. Now, there are also some hybrid securities I'll mention. One is preferred stock. So generally when I talk about stock, I'm talking about common stock. There is another class called preferred stock. And preferred stock is almost like a hybrid between a bond and a stock. A preferred stock, it's not used as much in financing. However, it's a stock which has no maturity, kind of like an equity. However, it has a fixed dividend payment. However, the company may choose not to pay it. So it kind of has elements of both a bond and a stock. And second, you have convertible bonds. Some bonds can convert into stock at some predetermined rate. So I say a bond can turn into 5 shares of stock at the option of the owner of the bond. So that's your equity financing. Let's talk a little bit about debt financing. The advantages of using debt, both bonds and loans, is you get the interest tax shield. The IRS allows you to deduct interest before calculating taxes, so it creates a tax shield. It also encourages discipline by management. If I own a stock in a company and the firm has a fair amount of debt, there's very little discretion for the manager to say buy that extra corporate jet or take a really risky, make a really risky investment because they don't have a lot of room for error. So some people say that some debt encourages some discipline on management. It does not, or equity or debt financing does not dilute ownership, and generally, cost of debt is generally less than the cost of equity. A disadvantage of using debt is you have the risk of bankruptcy or financial distress. So, and when I say financial distress, the firm does not have to go bankrupt to have a problem with their debt balances. If it's just perceived that they could go bankrupt, they might lose key employees. Suppliers may stop extending credit. Customers may leave them. So what we say is it creates either the risk of bankruptcy or financial distress. And also when you issue debt, you lose the future debt capacity. By not issuing debt, you have this ability to issue debt in the future for, say, a big purchase or a merger or an acquisition. Now, when we talk about debt, we talk about loans and bonds. Let's talk about loans. Loans are traditionally like your mortgage, your car payment. Firms can go to banks, especially small and medium-sized firms that don't have access to bond markets, and they'll get a loan just like your car or mortgage. And they're usually often level payment, amortized loans with monthly or quarterly payment. And those interest payments create a tax shield, so the firm actually pays whatever the interest expense is times 1 minus the tax rate. And also, those bank loans often have many covenants that restrict business operations. Let's take a look at a particular loan. Let's look at an example of a 5-year, $100,000 principal, 5% quarterly payment loan, in which the payment has a level loan or level payment. And what we're going to do is calculate the loan schedule and the after-tax cash flow for the firm. So I'll go to my start file. And the first thing I'll do is I'll figure out what the payment is. Well, the quarterly payment, is going to be determined on the quarterly interest rate, which is 5% divided by 4. There are 20 payments, so 4 payments per year, because it's quarterly, times 5 years. And then I'll put a negative sign on $100,000, because if I don't do that, it's going to make the payment negative. So I just want to show that as a positive number. So what is the level payment for a quarterly frequency 5-year loan with a 5% APR? That payment quarterly is $5,682.04. So let's now figure out the cash flows for the firm. And what we first have to do is calculate a payment schedule. So the firm's going to start off owing $100,000. Each period, it's going to pay the periodic interest rate, I'll anchor that with an F4, times the beginning balance. So the first payment is going to pay $1,250 in interest. The total payment is $5,682. So if I subtract the interest component, and I want to actually anchor the total payment, they paid $1,250 in interest and $4,432 in principal, which means their ending balance on their principal, or their payoff amount of the bond or of the loan at the end of the first quarter, is $95,000. Now that is also the beginning balance for calculating interest the next period. So I'm going to copy this little row here and see that the interest in the second quarter will be $1,194. And if I take that and subtract that from the level payment, that tells me the principal pay down. And then at the end of the second quarter, the ending balance and payoff amount is $91,000. Now I should be able to copy this down. And what you see is the magic of that level payment function we used in Excel is that it just works out that the exact principal component of that last payment is exactly equal to the beginning balance. So this is the payment schedule that you can compute for your mortgage, for your auto loan, for your student loan. The only difference is you do it monthly, so you'd have a frequency of 12 times per month, and you divide the interest rate by 12. So that's your loan schedule. So next thing we'll do is calculate, well, what is the actual cash flow to the firm for paying off this loan? Well, if there were no taxes, the actual payment would be $5,682. Let's actually do the cash flows. The firm is going to receive $100,000. That's the first cash flow. It's then going to pay the principal and pay the interest. However, the interest gets a tax shield of 1 minus the tax rate. And I'll anchor the tax rate. So the firm is going to pay all the principal minus 60% of the interest, because it creates a tax shield. So the actual payment is $5,182. Now if I copy that down, these are the 20 payments the firm's going to make after taxes. Notice I took an IRR of these cash flows, and what this is telling me is the total cost of borrowing 100%, So the total cost, and if I took off, and it's taken an IRR times 4, looks like 0.75% is the total cost of that borrowing. However, I need to multiply that times 4, the frequency. So this loan is really costing them 3%, which is the after-tax cost of debt. So if I take the APR 5% times 1 minus the tax rate, it gives you 40%. And this just proved that by using the after-tax cost of debt, it does capture the true cost of the loan. Now, one reason that firms tend not to, especially larger firms, tend not to use loans is that loans often come with covenants or terms in which the firm has to conform to. So there are typical affirmative loan covenants, things that the firm has to do to meet the requirements of the loan, and there's negative loan covenants, or things the firms may not do because they have a loan. So for example, a typical loan covenant might be that you must maintain insurance policies on property, general liability, and key person life insurance. You must have audited, reviewed financial statements and tax returns submitted to the bank, and maybe even a personal tax return. You may have to maintain liquidity or performance ratios, and this could be very difficult for a firm. Maybe they specify you have to have an operating profit margin or EBITDA profit margin of 30%. Or maybe they say that you have to have a liquidity ratio, say current assets minus current liabilities has to be positive. So what they're trying to do is trying to make sure that if you or the business starts to turn down and you do not meet these ratios, they can actually call the loan in and say, hey, I knew I lent the money for 10 years, but I want the money back next month. They may also ask you to maintain collateral or compensating balances. Also, other loans issued after the current loan may be subordinated. So they may say, hey, all future debt has to be subordinated to this loan, meaning that the current loan, the first loan, gets paid first. There's also negative loan covenants. For example, there may be no changes in management or mergers without approval of the bank. There may be no further loans or leases without approval of the bank. There may be no distribution of profits without approval of the bank. There may be no sale or purchase of equipment without approval of the bank. Because what they're worried about is if business starts to turn down, the firm may, you could just have your firm pay profits to the owners and leave the debt holders left out to dry. Or you might start selling off assets and again, paying the owners. So they're worried about all these things happening, so they create all these covenants. Now, again, a breach in these covenants will probably first start with a caution letter telling you that maybe one of your ratios have been exceeded or you didn't submit a report. They may give you a default penalty. So they might say, hey, you owe us some money because we specified some penalties. They may say, hey, because your operating profit margins have decreased, your interest rate is going to go from, say, 6 to 8%. Or they may just call in the loan and say, all right, I know I promised to lend you this money for 10 years, but it's now a 2-year loan or a 1-year loan, or hey, all the money's due in 6 months. So a lot of businesses try to avoid these onerous covenants, and they go to the bond market. Now, a bond is simply a loan that's traded. So it's a loan agreement. So for example, a bond, so instead of going to a bank and borrowing money, you could issue a bond. An investor will buy it, give you the cash, and you promise to pay the holder of the bond, not just the bank or the original buyer. So here's an example of a 5-year, $100,000 bond, just like our loan. However, bonds are typically semi-annual payments, so the frequency is twice per year. And the major difference between a bond and a loan, as far as the corporation is concerned, besides not having covenants generally, is there's no payment of principal. All the principal is paid at the very maturity of the bond. So there's only interest payments until the maturity of the bond, and then the principal is prepaid. So in personal finance, we call this an interest-only loan. So let's go ahead and build a payment schedule for this bond. So again, the beginning balance will start out at $100,000. This is a 5% semi-annual payment bond, so the interest, 5% divided by 2 is 2.5%. I'll anchor that, times the beginning balance. There is no principal payment, so the ending balance is always going to be the beginning minus that 0 ending balance. So you still owe $100,000 after the first quarter. I'm sorry, this is actually should be a 6-month period. So your ending balance is still $100,000. I can copy this down, and we're just going to simply pay your $2,500 every 6 months. Oops, I need to change this little formula here so it doesn't keep adding 1. So this looks like the loan schedule. You just pay $2,500 every 6 months, except this last payment, you're going to include a $100,000 payment. In addition, you're going to pay your we call it par or principal, or sometimes called the face amount of the bond. That last payment, you're going to pay the holder of the bond $100,000 and plus the $2,500. So these are the cash flows of a 5% semi-annual payment $100,000 bond. So let's look at the after-tax cash flows as far as the corporation is concerned. They're going to receive $100,000. They're again going to pay $2,500. They're going to get a tax shield on that, so 1 minus the tax rate. Anchor it. So this looks like the payments. Except that last one, they're also going to pay the $100,000. So these are the payments of the bond. Again, I set this example up that is exactly equal to the terms of a loan, and what you see is this also has a 3% IRR, or that's the effective cost of the loan, which is the after-tax cost of debt. So there's the payment schedule for a bond. Now, one thing about bonds is bonds are traded in markets. So if, say, the first person paid you $100,000 for this bond, so you receive the $100,000 as a corporation. However, the bond price fluctuates every day, and they could sell it to someone else. Let's say that the person holding the bond, gave you the $100,000 and has these contractual payments that you have to pay them, the bondholder. However, they decide they want to get rid of the bond. They want to sell it. Unfortunately, the bond price drops to $99,000. So for whatever reason, maybe there's some bad news about your corporation, or something happened in which the bond price is now only $99,000. Well, let's talk about the second person that buys the bond. So now, again, let's recap. The firm issued a 5% bond and raised $100,000, which was the price. However, let's say in the same day, the investor, some news was released, or maybe the next day, news was released, and the bond became less desirable. So they had to sell it. Now, and say the price went to $99,000. Now, the second person that buys this market, and we call it the secondary market, will pay $99,000 and receive the same cash flows. And these are the pre-tax cash flows. Now, the second person that bought the bond, they're getting the same promised bond cash flows, although they only paid $99,000. So the IRR of the bond investment for that second person that bought the bond in the secondary market is they're not earning 5% pre-tax, which is the stated rate of the bond. They're actually earning 5.23. That's because they paid $99,000. Right? If they paid $100,000 for the bond, they would earn exactly 5%. But since it dropped to 99, they'll earn 5.23. And this is how bonds trade in the secondary market. They bounce up and down with changes in interest rates and changes in the credit of the company. Now, the IRR of a bond investment, and again, notice I had to double the IRR, because if I don't, it would only give me a 6-month rate of return. The IRR of a bond investment is called something very special in finance. We call it the yield to maturity, or the YTM. However, I didn't actually have to specify all the cash flows to calculate this. Excel has a function. So I'm going to put in the parameters for Excel's yield function. And the yield function requires, one was the purchase date. When did you actually take possession of the bond? When does the bond mature? And this is a 5-year bond. What is the annual coupon rate, called the rate? How many payments per year? It also asks for a number called the redemption. Now, it's always going to be 100, and that is the percentage of the par or principal that is paid at the maturity of the bond. And the last thing it asks for is the price. Now, you have to quote bond price a very special way in this example. You always have to quote the price as a percent, as a price if par were $100. So this bond is selling for $99,000, and the par is $100,000. So it's selling for 99% of its par. Now what Excel requires is you to put in 99. And that's how we actually quote bonds in the bond market. We say that bond is not, we don't say it's selling for $99,000, we say it's selling for 99. What that means is 99% of par. So now I can use my yield function in Excel, put in my settlement date, maturity, the annual coupon rate, the price of the bond, the redemption value, and the frequency. The last one's optional. And there you get the 523. And what this represents is the yield or the rate of return that an owner of the bond would get if they paid this price. Now notice if the price were selling at 100, you would earn exactly 5%. If the price were selling at 101, you'd only earn 4.77. But this bond I just assumed was selling at 99. So that's how bonds work. I'll just talk to one slide about the choice of whether a firm should issue short-term or long-term. But to do that, I want to introduce an idea of a yield curve. Up here you see this is a Treasury yield curve as of 2016, and it shows that the government can borrow at about 0.1% for 3 months. That's annualized, or borrow at 3% annualized for a 30-year bond. So that's a bond which the government issues. This is generally we see upward sloping yield curves. And the reason why we generally see upward sloping yield curves as well, over the last decade, we've had a history of the Fed trying to keep short-term interest rates low to help the economy grow. But in general, yield curves are upward sloping because longer-term bonds are riskier than short-term bonds, and you have to pay investors a premium. And the reason why they're riskier is, one, there's for any bond, the longer term it is, there's more chance you don't get your money back. So it's riskier as far as default risk. There's also more interest rate risk. You have to tie up your money for a longer period of time. So you have to pay someone a premium for tying up their money for a longer period of time. So for those reasons, those long-term bonds are risky, and the Fed's keeping interest rates low in the short run to keep the economy going. There's an incentive for firms to borrow short-term, even though they want to borrow money for long-term. And here's a yield curve in a table format. It shows that in 2016, a 2-year single A yield on a bond is about 1.19. That's annualized. And the 2-year is about 4% for a single A. So it's an extra 3% per year. Now, so you'd think there'd be incentives for firms to, even if they needed money for 20 years, to borrow short and then maybe get a 2-year bond every 2 years, right? That would be called refunding. If you needed money for 20 years, but you wanted to take advantage of the short-term interest rates that are low, you'd have to refund the bond every 2 years. So you get basically 10 2-year bonds. The problem with that logic is that with an upward sloping yield curve, short-term interest rates are expected to go above that long-term interest rate, and investors and borrowers would be indifferent between borrowing short and borrowing long. What that means is that 2-year rate, that 1% now, eventually is going to exceed 4%. So those last few periods, you could be paying 6, 7, 8%. On average, you will pay about 4% if you do that strategy of buying a bond every 2 years. So you should be indifferent between getting that 4% bond for 20 years and that 1% bond every 2 years. And if you're indifferent, maybe I'll suggest that you should probably borrow long term, because it just creates risk. If you're indifferent, the second strategy the strategy of using short-term debt is just riskier. So firms have a choice of borrowing short-term and refunding it, or borrowing long-term. Now, there are other bond types and terms I want to talk about. One way of thinking about a corporation's choice of issuing bonds is they're going to try to issue a mix of maybe short, medium-term, long-term bonds. They can also add certain features to the bond to make it attractive to certain investors, and their goal is to try to minimize the cost of debt by offering a full menu of bonds for different investors. So first example, they can set up different bond classes. They could have senior secured bonds, senior unsecured bonds, then subordinate. And that example, and what you're doing there is you're appealing to different investors. Now, the senior secured bonds are going to be the first to be paid if the firm goes bankrupt. And then comes senior unsecured and then subordinate and junior bonds. So what you're doing is you're creating a different class of bonds that may have different ratings because you're trying to appeal to different investors. Or you may offer, say, third-party guaranteed or insured bonds. You may also offer, it's not very common, but you can have an amortized bond. So if the investors want to get their money back faster, they can request an amortizing bond. Two other features that can be put on a bond is you can make the bond puttable. What that means is the owner of the bond may just, even if it's a 10-year bond, may have the option to return it to the firm and get the par back earlier. So it gives the investor an option to send the bond back to the issuer, the firm. So that's probably valuable. So you might be able to get a higher or lower yield when you issue that bond because those investors get an extra option. On the other hand, the firm may make the bond callable. And that's the advantage of the firm, so they'll probably have to pay a higher rate on that one. A callable bond is which the issuer has the right to recall the bond, call the bond back. So you might issue a 10-year bond, but after 2 years, you have the right to call it back and give the issuer back their par with maybe a little premium on top. So that example, what we'd call that bond there, we call it a 10 no call 2. I mean, it's a 10-year bond, which means it could last for 10 years, but after 2 years, the firm has the option to recall it. But again, what they'll probably do is have to pay a higher interest rate on that bond. But it then does protect the firm a little bit because the firm now has the option of recalling it after 2 years or extending it for the full 10. Now, leases are also a source of long-term financing. If I needed a piece of capital expenditure, I could borrow the money or raise equity to raise the cash, or I could just get a lease from the actual firm that creates the piece of equipment. Now, a lease is either classified as an operating or a capital lease. If it's an operating lease, it's just treated like an operating expense, like every other operating expense. However, if it is considered a capital lease, the present value of the lease expenses is recorded as debt on the balance sheet, and interest is imputed on this amount and shown in the income statement. And here are some standards for when a firm's lease has to be considered a capital lease and recorded on the balance sheet. So last couple slides, and that is, one, let's talk about optimal capital structure. One way of maximizing the value of the firm, well, there's two ways you can think about maximizing the value of a firm or a project. Maximize the cash flows or minimize the cost of capital, right? Think about the NPV formula. It's the present value of free cash flows discounted at the cost of capital. So you can either maximize the cash flows or you can minimize the cost of capital. How you can minimize the cost of capital is trying to minimize the cost of equity. So let's get that right mix of common stock and preferred stock that minimizes the cost of equity. Let's get that right mix of long-term bonds, short-term bonds, bank loans, and maybe senior and subordinated bond terms, and callable and puttable, and have all to try to attract as many investors as possible to get the lowest cost of debt possible. And the last thing you can do is just manage the overall mix of debt and equity. So the following slide just gives you an idea of a simplified model of how you can think about optimizing the mix of debt and equity to minimize WACC. And what I've done is I just set up a spreadsheet in which I have a bunch of information about the firm's value, risk-free rate, market risk premium, their unlevered beta, a tax rate, and then the debt to equity ratio. I then calculate the debt percent, equity percent, the levered beta, CAPM cost of equity, and WACC. Now, the only thing I did to this model to make it interesting is I made a really simplified debt model. And I say that the cost of debt, the rate on your bonds and loans, are equal to the risk-free rate plus 10% times the DDE ratio. Now again, this is a very simplified model, just giving you an idea of the intuition behind what drives the cost of debt. So I then set up a data table. If the DDE goes from 0 to 0.9, your WACC goes from 13 to 14, down to 13 and back up to 14. Well, actually the first one goes from 14 down to 13, back up to 14. And if I graph that, adding a little bit of debt starts driving down my WACC. And that's because cost of debt is lower than cost of equity, and that risk premium from the beta and that DDE factor on the cost of debt are smaller than the effect of just moving to a lower cost of debt. So this is taking advantage of basically the fact that cost of debt is cheaper. And it's another way of thinking about it, it's maximizing or starting to take advantage of the tax shield caused by debt. And so at this point here, about 0.4 DDE on this simplified example, this becomes the optimal DDE ratio. After that level, those risk factors of the beta and the fact that beta is getting bigger, and the fact that 10% times the DDE on my cost of debt, it starts going up. So in this example, looks like 0.4 minimizes my cost of debt. So that's one way of thinking about optimal capital structure. What is the mix of DDE that maximizes firm value or minimizes WACC? All right, last slide. What's the evidence on capital structures? What have we learned by studying this topic? Two studies I'm going to talk about. One study has shown that the primary driver in a DDE ratio is not changes that the firm makes. It's not a conscious choice of issuing more debt or less debt. It's actually just the movement of the stock price, right? Remember, the DDE ratio we're talking about is the market value of the stock over the market value of debt and then the market value of debt. So studies have shown that as much as firms could try to manipulate their DDE by changing the mix of D&E issuances, debt and equity issuances, really what drives DDE is just the variations of their stock every day. So that makes it kind of interesting to think about that maybe firms don't really have a lot of control on their DDE ratio. Other studies have done cross-sectional analysis and found that leverage, the DDE ratio, doesn't really affect, or they haven't found evidence that affects the firm value or the WACC. Well, that's kind of disheartening. That tells me that that DDE doesn't matter. The implications of these studies say that maybe the tax benefits of issuing more debt are perfectly offset by the costs, which means the risk premium, the beta, and the risk premium on debt. And this also implies that maybe the choice of debt to equity ratio and the right debt securities and equity securities really doesn't really matter as far as driving firm value and WACC. It also says, so this kind of disheartening that it doesn't really matter what we do as far as debt to equity ratio and the choice of securities. There's one good thing that comes out of this though. That is, if the DDE, if your mix of debt and equity really don't matter and can't really explain WACC, maybe there's an easier way to calculate WACC than we've been doing. And that is, if the DDE doesn't matter, let's just assume no debt and just plug an industry beta, an unlevered industry beta, into the CAPM formula. And that might be a good way of estimating the WACC of your firm. A very simple way of calculating the WACC of your firm. Just take an industry unlevered beta, plug into the CAPM formula, and call it your WACC. Another implication is that in capital budgeting, and this is what I found in practice, in capital budgeting, don't spend that much time on the discount rate. All right, maybe we do the above example and that I just calculate a WACC based on unlevered industry beta. What that says is I should probably spend most of my time worrying about the cash flows and not the discount rate. Now, these findings are controversial, and most people in finance practice believe that there are some advantages of using debt, especially if a firm's, say, a mature cash cow, they can take advantage of those tax shields. So this is controversial. And lastly, if you want to follow the link here, there was a survey of CFOs and talking about what they prefer to use. And it feels like there seems to be kind of a pecking order going there, that firms prefer to use internal funds or cash, then debt, and then finally equity in that order. So on this topic, we've talked about capital budgeting. If your capital budgeting exercise have determined a bunch of positive NPV projects, and you're going to raise capital, you can use cash, equity, or debt. And we talked about different implications of using all three of those, and also we talked a lot about the difference between bank loans and bonds. We also lastly talked about optimal DDE ratios and some empirical evidence on creating an optimal capital structure.